You can see right around 8:30. Here is the 8:30 candle, right around when Canadian CPI came in hotter than expected. The gold chart actually started to fall. And why is this? Well, remember that when we talk about this often, if you're somebody who is a gold trader, if you trade gold frequently, this is something you definitely have to understand if you're trying to understand the fundamentals as well, is that gold does not just look at the US. A lot of people think that it only looks at the US economic data. And while the US economic data is very, very important to the story for gold, like a strong US economy is not great for gold and a weak US economy is usually decently positive for gold, it's not just about the US. Gold also considers Canada. It also considers the ECB and what they're doing, right? The European zone. It also looks at the UK, looks at Asia, right? Gold is kind of the anti-fiat currency vessel. And what I mean by that is that if currencies and global economic growth is really strong, gold becomes less attractive. Gold is ultimately, it's like an alternative investment class. So for people who are like uncertain about the economy, if they're concerned about geopolitics globally, something going on, right? People will buy gold as like a safe haven, as like a defensive maneuver. But they will do the opposite if things look really like the up and up. So when we see Canadian inflation coming out higher than expected, gold looks at it, right? Gold is like this all-seeing eye. The market sees, oh, CAD inflation is hot. They may slow their rate cut process. And gold then says, oh, well, hey, look, if they're going to slow their rate cuts, that's not good for gold. Also, check out the new sound. Just added this one today. I think like the traditional idea is like a strong consumer means that, again, there's a lot of spending going on. There's going to be travel. There's going to be, people investing. There's people buying homes. And if they're feeling concerned, they may not do that. So it's like strong or weak kind of economic activity. But, it is one of those things, as you mentioned earlier with consumer confidence, it can create a big spike, but it's kind of rare. Like it's got to be meaningfully different than expectations to really get the market to move. So, in terms of like highlight events, I think your CAD CPI idea was kind of a big one this week. We also saw, I think GDP numbers could be interesting on Thursday, but it is final GDP, which typically gets a little less volatility than like advanced GDP. Right. But that being said, any big surprises on any news events are really what usually will get the market to move substantially. So I guess another question for you, Nick, as we get closer to this event is, what are your thoughts on the dollar right now? I'd be curious just to see, you mentioned the dollar for a second there, price action wise, or in terms of sentiment wise, what are you thinking on the dollar?
So the dollar is in an interesting place right now because over the entire year, the sentiment of the Fed has changed drastically. I mean, we went from 3 cuts, I think we were priced in at March, but December we were pricing in 6 cuts this year, down to 3 cuts in March, down to I think 1 now, if I remember correctly. We're fully priced in for 1 cut this year. Mm-hmm. And so, all year, basically, I've been waiting for dollar shorts to start coming into play in a real way. And it's just been pushback after pushback after pushback with that regard. So I think for July, we're going to see a hold. I would not be surprised if we stay in this little area right here for the next few weeks. I'll draw it up real quick.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
In between, 107 being max. And like 103.5 maybe. Like, I would not be surprised if we just bounce around in here over the coming weeks as the markets, push back rate cuts, but don't really say much about hikes. Now, we have had a couple hawkish Fed members this morning. Let's see here.
Was it Waller that spoke this morning, or was that someone else?
We had Bowman speak.
Okay.
Yeah, so it was Bowman at 7:30. I'm still open to raising rates if inflation doesn't improve. I don't see any rate cuts for 2024, so he sees zero this year.
Yeah.
He sees us as completely staying where we are, no rate cuts. Now, he did say he's open to hikes, but he didn't say that he sees any for this year. So, it's kind of anybody's guess there on what his outlook is as far as hikes are concerned. Are we going to get any this year? I think significant inflation numbers will continue to see us, or we'll continue to see the Feds shift a little bit more hawkish. They've been shifting. I like to see hawkish and dovish as like a sliding scale. On one end you're dovish, on the other end you're hawkish, and the Feds have been moving from dovish all year to the hawkish side. And they're still mostly dovish, but leaning back towards that, swinging back towards that hawkish side of the pendulum.
Yeah, and that's the thing is, as you get this week, you've got the PCE number coming out. The big thing here, I think, is we're coming into another round of inflation data, CPI data coming back around, and jobs data. And it's about time that the market kind of makes a decision on this, because if you get, here we are, we're in late June, right? We're going into July, and people started out this year, as you mentioned, wanting several or expecting several rate cuts. There was optimistic people were saying 6, the Fed was saying 3, and now we're talking about 1. And so you take that as a difference in kind of where we started this year to where we are now. The question, however, is for the people who still think we might get 2, if they're going to see 2, what do they need to see happen? They need PCE to come in light on Friday. They need jobs data to show continued cooling. We have seen cooling in the labor market. Like if you take a look at claims on the rise, job openings deteriorating, unemployment rate rising, wage growth kind of slowing slightly. We are seeing some progress in the labor market. And even Jerome Powell in his last press conference mentioned that he thinks that this might have just been kind of an outlier NFP event, that it might actually come in cool or revised lower in the next round of data. But again, all questions will be answered or a lot of questions will be answered in the next round of data. Are we going to see, NFP come in lower to really solidify that the jobs market is cooling? And perhaps most importantly is, while you have all this labor cooling, do you get the cream of the crop, which is, do you see inflation data start to materially trend lower? Because what we're seeing, and dollar bulls have held on to this, and this is a bull case for the dollar, is that while other places are seeing their inflation continue lower, the US has seen inflation flatline over the last year. That's the bull case, I think, for the dollar, is if you're going to lose the bull case, if you want to see the dollar go bearish, you've got to see that trend continue down towards that 2% inflation target, like we've seen in some of the counterparts in Europe. Like if you add in the UK, here's the UK in green, and you can see, I know it's a little hard to read here, it's come down and it's kept going down, and they're at their 2% target rate. So would it be expected that they, again, begin to cut rates? And that is the expectation. So that's the real question, I think, as we go into this data, why it matters so much to markets is, if we're gonna see rate cuts, you've got to start seeing progress on inflation, and that is why I think CPI is probably the event of the month in July.
Yeah, my biggest question is sort of like Powell was saying at the last FOMC meeting is how many CPI prints do we need to see to solidify a cut?
Yeah.
Or two? You know, is the next one, is July and June coming down slightly? Is that enough?
Yeah.
Is that enough to convince the Feds that it's time to cut, or are they going to need to see 3 more? You know,
Yeah.
not just June and July, but June, July, and August. Are they going to need to see? You know, so that's a pretty interesting. How long does a continued move to the downside need to be happening in order for them to go, we're ready to cut? And I know that they say that the elections don't have any you know, play into it, but I mean, I think as traders, we have to ask ourselves, do they?
Yeah, right.
Does the election cycle really come into play when it comes?
Well,
to
they're only the people who make these decisions are human beings. You know, they're all susceptible to bias and opinions. So yeah,
Right.
I think you're onto something with that for sure. You're joining us here, Chris. Just about 30 seconds to go, actually, before we get our consumer confidence numbers this morning. I don't know if you heard what I was saying just a moment ago, Chris, but to me, the consumer is really important right now. In fact, arguably, in my opinion, more important than even what the Fed does, as long as they're still going to cut rates at some point. Would you agree, or do you think the Fed is more important than that?
No, I think right now the market needs other reasons to justify up. The Fed story is kind of played out. I'm still a little confused with why the market so desperately wants to see rate cuts, outside of the fact that maybe it's priced in so many good things that it needs the cuts to justify why it's ripped and gone the way that it has. Because historically speaking, when the Fed starts cutting rates, those cycles usually mean tops. So
Sure.
this would be an interesting time to see that. But I think right now the consumer is stretched. We're at all-time lows in affordability for homes. Inflation's trending the right way, but it's still sticky. The consumer is pulling back. We've got household debt, and I don't know, maybe the consumer is on paper probably healthier because everyone has more like household equity.
Sure.
But unless you're going to cash in on that, unless you're going to sell your house, unless you're trying to, sell high and buy high,
Or
I
sell
do
your
think that.
stock, one or the other.
So I mean, so it's like you've got to clear some assets up to like kind of keep the lifestyle going. So I think that's the concern. But at the same time, I mean, I do think the top echelon. It's like they might cut back on retail, but if you look at hotels, travel, flights, TSA numbers, like people are still traveling. I think it's more maybe the consumers switching from retail goods to travel, tourism, leisure, like experience goods. That makes sense?
Yeah.
So I think they're still spending, but I think the consumer is really important because are we going into a consumer slowdown and an economic slowdown and an election year? So I mean, there's things that could certainly snowball into making things way worse. So.
Yeah, I mean, I'm kind of in the camp, Chris, of like, I would like to see, by the way, for those of you wondering about the consumer confidence that just came out, it came out pretty much exactly as expected. That is why there's not any volatility. It's like playing the news and they're just talking about like a local, art festival. Like it's not very exciting to participants, just like watching the news and finding something boring on it wouldn't get you to turn the TV on. That's just my analogy for basically news was not exciting enough to get a big move going. Came out exactly as expected. But yeah, I mean, Chris, to me, it's like the consumer, matters because it really, when I say consumer, I'm talking about, data in general, like the labor market as well. Like if we see a continued trend where inflation stays hot and, labor data continues to accelerate lower, like cool, that's where I get a little bit concerned. But I would love to see the consumer stay relatively strong and labor data to kind of cool at a mild rate. But really what unlocks the next bull market high for me or like wave higher would be inflation finally having some progress, because then I think that's what a lot of the bears would point out too. That's what they're concerned about. Would you agree?
I do agree, and the next move higher is capitulation. I think that's the blow off top that we thought we have had like this bull run, but I think the next the next move that is higher, if it's going to be higher, is going to be like this scary high move. Let me I know I'm not sharing my screens here, so let me go. I was just getting a futures trade in for the Russell. Let me go SPX right here. So I still think that we could be entering into a bit of a summer slowdown. So let me throw my screen up here, Nick. Summer slowdown would make some sense just based on the seasonality. I think we talked about this on the show. It's been like since 2018, 2019 since we had a sideways move. And here we are looking at, everything's been pointed up, everything's been bullish. NVIDIA's kind of come back to a reality. It shed about $300 billion in market cap over the last 3 trading days, which is kind of wild. You said you want to buy this thing 80, 90, 100?
Like 95 is what a level that I had on my thing.
Okay, I put in ratio spreads on NVIDIA to try to get a 95 long put with an 80 sell put. So I'm doing ratio spreads where if I own it, I'm going to own it like sub 80, which again might be really, really, that's asking a lot from the market, but I'm going to set it. It was volatile enough that I got a decent credit for it. So we'll start there. And then I also took profit on NVIDIA from a trade that I did with Frank last week. So we did a short-term trade that was out to this Friday. That trade took profit. I've got another one out to August to let just NVIDIA volatility hopefully kick things around for a couple of bucks. So if we let's just talk sideways. Let's say the market right now is kind of topped out. If we don't take out the April lows, and let's say we chop around here through June and July, it would be understandable that we're going to have a little bit of indecision. I think what gets nuts is a blow off top that brings in 6,000 plus in the S&P or 600 on the SPY. That's going to be what everyone should be happy about because it's going to be great for the portfolios, but that makes me a little terrified to see what that looks like 12 to 24 months later.
Sure. Yeah, and that's the big question is, when I was talking about NVIDIA earlier too, I was saying like what I think is healthy for the market would be a bigger pullback in NVIDIA. I think like this like small leadership in the market is not sustainable. It's not like healthy in the long term to only see. And yesterday we had really good signs of some broadening out, which I think is great. Like I'd love to see NVIDIA take a breather, but then let energy and utilities and financials like have a little bit more of a squeeze higher. Like let that lead for some time. And I think that would be again very, very healthy overall.
Yeah, let me ask you a question. So this growth to value, statistically, there's some interesting takeaways. So the last time we had a big outperformance by value compared to growth, it would have been post 2000 bubble. So when we got into value was getting just hammered by growth, but over like from 2000 to 2006, value outperformed growth like 87% to negative 10% or 15%. The problem was neither one were really that positive. It's not like value became like the greatest thing ever. Some value was great and it kind of sustained the portfolio. But remember, if you're in a down market like a 2000, 2001 or a 2008, 2009, or 2007, 2008, if you're going into a down market, very little is safe. So, I mean, if you're going to be making money in a bear market or a down market, you're going to have to be bearish. You can't just play defense and play protection and, make money. You can not lose money, which is obviously great, but you have to play like aggressive defense or, take the offensive on the bearish side to make money in a bear market, like, a Druckenmiller or, somebody a little bit more that's really made a career out of like heavily leveraged asymmetry when it comes to a bear market. So that's a tough camp to be in, obviously, I think, but I'm just curious, like, do you think that we are so entrenched in tech and so entrenched in growth that value might never be the same?
I think that in terms of growth versus value, it's a really interesting conversation. And I just wanted to also touch on that point you made about like, you cannot like out defense a bear market. There's just no way, because what Chris is pointing out, for those of you guys who may not have caught the full, like, the great point that was made there, is that if you go look at any like traditional asset, bonds, stocks, growth, value stocks, everything except for energy and the dollar in 2022 was down. And some things were down horribly, some things were down a little bit. But even the Dow Jones, if you had just said, I want to stay in the Dow, you're still down. Like, I think it was like 12 to 15%. It might've been a little bit more than that. S&P was like down like 25, and the NASDAQ was down like 38. So that's 2022 as a recent kind of example. But the frustration about a true bear market is that everything becomes very, very correlated. And it's really frustrating because it's like you can't hide in a real bear market. In a real sell-off, everything gets crushed. Barring, depending on the situation, bonds can be a safe haven. But in 2022, they were certainly not a safe haven because it was rate hikes to oblivion that caused the concern. If you get a bear market on just a straight up consumer really, really struggling, then bonds are probably going to look really good. Because in that case, then you have inflation really low, and you have like a consumer just tapped out, and unemployment skyrockets. Then the yields that are offered on bonds today may look really good. So maybe TLT or something like that can help you hide out a little bit. But it's hard to avoid a bear market and the tough sides of that. I think that, as you mentioned, you can get aggressive. You could start, if you're active, you can look for shorts. You can look for tactical, defensive, conservative shorting, because it is very difficult to do. But adding some sort of hedge as well is another way of doing it. Another way that I personally like to do that, Chris, is like, let's say you do get that blow off run higher in the market. I personally like to sell some calls. I feel like that's like a kind of middle ground to sell calls against some of my positions. There are ways to get constructive with it, but unless you are outright looking to short in a bear market, it's really tough to avoid the difficulties of that.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.